So I'm Gordon Fletcher. I'm a consultant with Mercer, and my day job really is consulting with pension funds on the whole, helping them to assess the risks that they're taking and ultimately manage them if that's what they're choosing to do. I'm facing a couple of serious headwinds this afternoon. Following Amy, I'm always a bit discouraged at how high she sets the bar. And also, secondly, I'm the last remaining speaker that stands between you and the bar. So I'll try and kind of keep this quite snappy. I want to focus on some work that I've been doing over the last couple of years with multinationals. And this has kind of really accelerated, I think, generally, talking to multinationals about the pension risk and trying to get them to be a bit cleverer about how they manage it. And you might think, well, why is consulting with a multinational any different to just having isolated conversations in all of the territories? I mean, you could get some very kind of fascinating and unusual sort of phenomena occurring. One thing I'll be sort of touching on later is a sort of a paradox of funding where you can get some areas of the world, some countries of the world like the US, which have very directive and prescribed funding rules, which paradoxically can result in very flexible actions by the sponsor. And then conversely, you can get areas of the world like the UK, which have really quite flexible funding rules that can result in a sponsor being highly constrained. So I'm just going to leave that hanging there, and I'll come back to it in 12 minutes or so, just to kind of check you're all still there. So let's have a look. Now, I'm going to talk about some statistics that we've uncovered on multinationals, and I do have some sympathy for demographers who are faced with poor data, but if you've ever worked with a multinational, you'll know that data is an enormous problem, and many multinationals just simply aren't aware of what pension liabilities that they have on the books. When you try and aggregate that up across the kind of whole universe to get a picture, you have to be kind of quite creative with some of the publicly available data. But nevertheless, we've done some work on this here, just trying to assess the scale of the problem here, specifically for multinationals. So this is looking at Eurozone and US multinationals, just almost 500 of them. Later on, I'm going to split them out between Euro and US multinationals, but here we've got more. We've got the liabilities and assets. It's a kind of familiar picture. The assets took a nosedive. They recovered. As Amy said, over $200 billion in contributions in the last few years alone are implicitly included in those asset figures. Okay, so we've seen great market performance, but we've also seen a ton of cash poured into these things. But really, you know, as you know, and you know, as our clients know, the story over the last few years has really been about the liability side of the equation. You know, generally, investment committees get very excited about the assets. What they've been blindsided on is the liabilities. Of course, it's all been about the interest rates, and also in the US credit spreads as well. So the assets haven't kept pace with the liabilities, and then despite these cash contributions going in, we're seeing sort of flat funding levels there. Funding levels, you know, getting around about 80%. This is on an accounting basis. More recently, ticking up a little bit, but really kind of quite a substantial problem in terms of funding. So let's sort of drill into this a little bit more. On the left here, we've got European domiciled multinationals, and on the right, US. This is kind of quite interesting, actually. I mean, for the European multinationals, I think the one thing that strikes you there is quite an even distribution of pension liabilities around the world. About a third of their liability is in their kind of home country, if you like. The rest of it in a mixture of North America, the rest of Europe, and you know, the other being, you know, potentially Far East, Australia, and places like that. You go to the US side of things, is kind of a bit of a narrow focus, it seems. For North American multinationals, over half of their pension liability is kind of domiciled at home in North America, with substantial proportion outside the US and Canada. I mean, one thing that's a truism among multinationals is they all observe the 80-20 rule. 80% of the liabilities is concentrated in 20% of the plans. So whatever multinational you look at, they might have 10 plans, say, but 2 of those plans will be the significant ones, and they will be based in the US or the UK in general, possibly Germany, possibly Netherlands, but generally the US and UK. So if you're helping a multinational to identify and manage pension risk, it's very easy and quick to zero in on where you can do the most good. It's likely to be in 2 plans, and they're likely to be in the US and the UK. One of the other compounding impacts, actually, just to say here on US multinationals, is they also generally have a very sort of strong investment bias to US as well. Their US equities are often sort of very sort of biased that way as well. So you kind of get this double compounding effect there in US. So let's look at the deficits relative to market cap, which is kind of quite a well-accepted way of looking at the scale of the problem here. I mean, market caps since the crisis have rebounded. Obviously, equities have gone up, which is good news. But I mean, you can see here, I mean, especially on the right, which is the US, deficits as a proportion of market cap, around about 5%. It hasn't gone down, and if anything, has really gone up. So the bad news is on the pension side of things. The markets have done fine, market caps are up. But the deficits are also up. Looking again at pension expense, and pension expense really is a proportion of net income. So how a company's income is being dragged down by their pensions. You can see the red lines there. Again, I think in Europe on the left, kind of quite volatile. In the US, sort of surprisingly constant in the last few years, I would say. Around about 10% of income is being dragged down by the pensions. And that's, despite a very rapid rebound in company incomes since the crisis. So again, similar picture. Let's look at cash. Okay, show me the dollars. Where here we've got pension contribution as a percentage of free cash flow, Europe on the left, US on the right. You can see the small blue bars at the bottom there show the cash amounts that have been put in each year, surprisingly constant. And they're going to be slightly different to Amy's results because these are in euros rather than dollars, so don't be confused by that. But the pattern here is kind of constant cash being put in year after year. And as a percentage of free cash flow, I think kind of surprisingly constant for the US in the last few years, sort of around about 8, 7, 8, 9, 10%. So kind of quite a material amount of cash flows being absorbed in the pensions. Let's just wrap this up with what is the strategy here for talking to multinationals? I mean, there's a very nice symmetry between the corporate finance world and the pension finance world. In the corporate finance, we've got decisions really based primarily around the 3 key ingredients of balance sheet, income statement, and cash flow. Trying to keep all those in a sensible balance to run the business. Very strongly mirrored on the pension side, where we obviously on the cash side, we have contributions being put in. The investment strategy, certainly in the US, can sharply determine the income statement, and risk management strategy impacts your balance sheet. So a nice symmetry there. We've heard a lot about risk, so I'm not going to dwell too much on the risk, but certainly from the corporate side, I mean, companies are not, they're not, risks aren't invisible when you're running a company, and it's kind of strange in some ways that they have a blind spot to pensions, but I mean, they're faced by a number of kind of core business risks, other risks, and financial risks. Let's look at how some of these are kind of translated in the pension world. So corporate risk here, operation risks, IT, financing, so on, create corporate risks, core business, financial risks, which impact on the three main ingredients: earnings, balance sheet, and cash flow. In the pension world, again, a similar sort of mirroring, where asset allocation, liability cash flows, and assumptions create risks, market risks, credit risks, interest rate risks, inflation risks, which impact on the pension metrics, the deficit, pension expense, and contributions. So let's have a look at a rather sort of complicated diagram, but working with these companies really is kind of having a strong project management bias and also having a strong governance framework to kind of make this work smoothly. And that's a very key thing, is governance with multinationals. And first of all, defining the key corporate objectives, understanding what the company is faced with, what they want to optimize, looking at the pension strategy there. We've got the funding strategy, liability management, buy-ins and buyouts. I haven't included longevity here, but we've had plenty of longevity. And these things are country-specific. Okay, the sorts of things that you can do in the UK are different to the sorts of things you can do in the US. In the US, you can offer people lump sums, terminated vesteds. In the UK, you can do slightly different things. So there's a bit of a different menu of options available depending on where you are. And you may indeed be very restricted, like sort of Germany and Korea and so on. You may be very restricted in what you can do. Defining the key pension parameters that you're going to look at, then testing the impact on the key corporate metrics, those metrics I was talking about, contributions of cash flow, pension expense in the income statement, and coming up with your strategic options. Do those options support what you're trying to achieve in terms of your corporate objectives? If they don't, sort of discard them. If they do, take them through. One recent case we looked at with a multinational, we've been working with them for a few years now. We've been able to report to the board that globally, they're going to, over the next couple of years, they're going to have reduced their liabilities by 30% and potentially their risk by 70% through progressive investment de-risking. So the impact, so the end result of this is not just talk, it's actual actions that can seriously reduce the risk that sponsors are facing.
Great, thank you.